European governments putting up $146 billion to bail out Greece. But so far, the reaction may not be what they were hoping for. The euro still under pressure as analysts are worried that the debt contagion may not be contained, and Greek citizens are in the streets protesting proposed budget cuts. Analyst Jonathan Lemco is following it all from Vanguard, one of the largest U.S. managers of stock and bond mutual funds. And John, good to have you with us. And you had yourself some doubts, right? Even if there was going to be an agreement this weekend, some doubts on how much help that could give to the Eurozone.
And that's right. I do think that Greece has now enough funding for the rest of the year. Apparently, they're going to get between 40 and 45% of the 146 billion just this year. But after that, I have real concerns about these austerity measures that have now been put in place and whether the Greeks, in fact, can adapt to that. We're asking an enormous amount of Greece. We're saying, look, at the end of last year, you had a deficit of 13.6% of GDP, an enormous amount, particularly for a developed country.
And now we're trying to get them down to below 3%, right?
By 2014. And if they do it, that might be a record in modern world history, at least for a developed country. So I remain very skeptical about this.
Skeptical and also fearful, perhaps, that if this doesn't work, then what happens?
If it doesn't work, then I suspect they're going to have to throw more money at the problem, the EU and the IMF together. And one lesson we learn from history is, you can't throw money at a fiscal problem. It doesn't solve it. It delays the issue. So I think we're going to be dealing with delay for a significant period of time. Greece, I think, remains very problematic for the foreseeable future, and that's going to be negative headline risk for the market.
Right, for the market, and also, John, right, for the other countries that are now being eyed. I'm talking about Spain, Portugal, and others, even Italy, being eyed as whether or not these problems could erupt in their own countries.
To some extent, Portugal is obviously the next one vulnerable. But it's important to stress one thing. Greece's problem is by several standard deviations much worse than Portugal. The culture is different. The resilience of the people is different. The sense that the government is more willing to address this problem, I think, is different. So although Portugal's got a serious issue and there is a contagion risk, I do have more faith there. I do think that for now, Greece will be ring-fenced, as we say, and for now, I think Portugal will muddle along. But you're right. I mean, contagion could happen, but it won't happen, I don't think, in 2010. We're looking at 2011 or 12, possibly.
Okay. And Jonathan, really quickly, just tell me, though, I mean, is the solution to all of this going to have to be an entire rethink of the euro?
I think the solution to this will have to be a reinvestigation of what it means to have a euro that's just a fiscal tie and without a monetary tie. And we may have to start talking about maybe closer political ties, as awful and as difficult as that could be. This euro is now in serious stress for the foreseeable future, yes.
Okay. All right, Jonathan, we'll have to leave it there, but good to talk with you.